Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Caron of Morgan Stanley saying he's not bearish, but skeptical, writing this: inflation is creeping higher and puts further scrutiny on the Fed's ability to cut interest rates. Tensions in the Middle East also create a potential for a more systemic type of risk. We can't forget that a bull in a candy shop is still just a bull, and bulls can be unpredictable. Jim joins us now for more. Jim, welcome to the programme. Let's run with that analogy. A bull run, if you will. A bull in a candy shop. Do you think we're a little too high on sugar right now?
I think that's a good way to put it. I do think of it as a little bit of a sugar high. My concern is that we're pulling forward 2025 earnings right now, and we're painting an almost near perfect picture going into the future. It's not that I'm bearish. It's not that I'm negative on the markets broadly. I just think that we're getting a lot happening really, really quickly. In other words, we're getting this soft landing that everybody's been projecting, but we're getting it very, very fast. Valuations reflect that, right? So if you look at $280 earnings, let's say for 2025, which is roughly consensus, you assign a 21 or a 22 multiple to that, you're going to get an S&P somewhere close to around 6,000, and that's about where we are today. But if you take that valuation down a little bit and you get it a little bit more normalized to say maybe a 20 PE on those $280 earnings, then the S&P is 5,600, right? So it's lower than where it is today. It's not a disaster, but net, we're talking about a few percentage points in either direction. I don't necessarily think that we're going to be in a very strong bull run from these levels or from these valuations. So that's where my skepticism is. I'm not saying that things aren't okay, consumer strong, retail sales was good, inflation, earnings, GDI numbers are all good. So incomes are good so people can keep spending. What I'm saying is, how much can it continue at this rate of change?
Well, let's take the valuation piece of it, Jim. This is what Cameron Dawson of New Edge said over the weekend. You could have argued at any point over the last year that stocks were expensive. I'm sure you'd agree with that. But there needs to be a catalyst to change this march to ever higher multiples. It feels like, Jim, we're in this virtuous cycle right now, looking for a disruptor to it. And Torsten Slok of Apollo spoke to the same thing. The Fed's cutting rates. They've got a bias to cut even more. So we've got a dovish Fed. We've got high stocks and high home prices. Public and private financing is wide open, as you can see. Continued support from fiscal plans. Low debt servicing costs that are locked in for both corporates and households as well, Jim. That's just feeding on itself. So the outlook just keeps on improving. Now, Jim, from your perspective, do you have anything in mind that could disrupt that process at the moment? Because that's the reasons people are so bullish right now.
Yeah, and I agree with those reasons, and it's why we maintain a bullish tilt in our portfolios as well. Moving more towards neutrals, not moving towards negative, because we do think that there are some potential factors. Clearly, tensions in the Middle East, a flare up there. We could get some election uncertainty or some election volatility around this. But ultimately, what we would need to see is damage done to the consumer and a rise in the unemployment rate. So I think some of the damage that could come is that if we start to see some weakening of the labor market. Now, we're not seeing signs of that yet, but we all know that the non-farm payroll data has been heavily revised over time. And if we do start to see that in a period where we start to see some margins starting to shrink across corporate America, that could create a significant or a faster move higher in the unemployment rate. And that would completely change the narrative. We're not there yet, Jonathan, and I think that's the most important thing to highlight. We're not there yet, but we do have to recognize that at these valuations and at these levels, that it makes it hard to have a positive surprise, and it makes it easier to have a negative surprise.
One aspect of your argument is essentially kind of abnegating this idea of a cyclical tilt, that you can get that rotation away from big tech and some of the arch behemoth, other large stocks, and really fuel this next leg of recovery. And I saw the same kind of sentiment from Mislav Mateka over at JP Morgan. How much are you leaning against the cyclical move, the idea that the equal weight and the Russell 2000 have been outperforming?
No, actually, Lisa, I mean, I think it's a great question. And actually, we're embracing the broadening of the markets and the cyclicals and even the defensives. So what the markets are kind of realizing right now is that this Mag 7, the tech and the larger cap and the growth names that are out there have done a very, very good job this year, but there may be more to the story, and this is going to be across the Russell, this is going to be across the broader base sectors of the markets, this is going to be across the equal weight. One of the themes that we're putting forward as we move into 2025 is how do you invest in what seems to be a fully valued market? You can't really play the beta. You can't just say, oh, well, the index is going to go up another X percent. More or less what you have to do is you have to start thinking about the different components of the markets. You have to find sectors in the markets that are well valued, that have lower PE multiples, good balance sheets, good factors, good interest coverage ratios, and have some pricing power and some controls. And you can find them in the other 493 stocks. And I think that's the stuff that we should be looking at. Those are the sectors, that's the management style that we need to start to move into, because I think it's going to be more about asset selection and investment selection as we move into 2025, as opposed to just a target weight asset allocation into X percent equities or X percent bonds. It's really going to matter how the constituency of your portfolio is made up, what sectors, where, and what valuations.
Is this a sort of 1-year time frame of an adjustment and investment cycle, or do you see this as a 10-year kind of time frame, as maybe the overall index level returns don't look as great as they have traditionally?
Yeah, I think this is something that probably adjusts over the next year or so. So let me call that short term. I don't think that we're always going to have this bifurcated market like we do today. I think there needs to be some coalescing, and that's where you get the broadening of the markets, where you get other sectors that haven't participated in the rally start to participate late. That's usually a late cycle thing to start to see. And then the markets tend to move in a more uniform way, beta up, beta down. So I don't see this necessarily as a long-term view, but I do say that 2025 will be all about tacticals. Don't forget, we're going to be talking about taxes and policy no matter who the next president is. We're going to start talking about that on January of 2025, because that's when the decisions are going to start to get made that are going to have big influences on markets going into late 25 and into 26, when policies are likely to change.
Jim, do you believe right now that the market is rotating into the Trump trade?
Yeah, I think it is. And I think it was said, nicely by Lisa, earlier on the show, that it's in some degree, it's a movement away from the blue wave, right? So I know we've been talking about tariffs, and we call tariffs a tax, but taxes are also a tax too, right? So if one candidate is talking about tariffs and another candidate is talking about higher taxes, they're both a tax. What does that mean to me as an investor? Inflation. And ultimately, no matter who the next president is, I think it's going to be really hard to get inflation under control. And that's one of the reasons why I think you see yields starting to move higher. It's not so much just a Trump trade or not, but I think it's a realization that we're moving to an area where deficits are still going to be high. There's still a large degree of spending that's out there, and the U.S. deficit is too high, by the way. And all of this is putting upward pressure on rates. And I think this is something that we're going to have to deal with as we move into the next months ahead.
370 September 18th on a 10-year when the Fed cut 50 basis points. 370 this morning, 413. Jim, it's good to see you. As always, thank you, sir. Jim Caron there of Morgan Stanley. Morris of BNP Paribas writing, US earnings are driving outperformance of the equity market. Still early in the season, but results are encouraging. Risk, if anything, is that growth is too strong and the market is too optimistic on the path of rate cuts. Dan joins us now for more. Dan, welcome to the programme, sir, as always, and good morning to you. Do you think there's too much of a good thing going on right now, then, in the US economy?
Well, we probably should enjoy it while it lasts. We know that bad things inevitably happen. We'll have some type of negative surprise, and it won't be another 6 weeks or 6 months of continued gains for the market. But broadly speaking, if you look at the environment, at least in the U.S., it is pretty encouraging. Stocks reflect that. We believe we're on a path to a soft landing. Rates are going down. We can discuss all day about how quickly that's going to happen and when the cuts are going to take place. But for now, we're kind of waiting for what that negative shock might be. But the economy does look look resilient.
Dan, you say soft landing. UBS says clients are asking us about a so-called no landing. What's the difference between a soft landing and a no landing? And how, from your perspective, does your approach to capital allocation decisions shift with either in mind?
Well, I think my interpretation of a no landing was that you actually don't get growth back to the long run average for the economy in the U.S., which would be, say, 1.75%. And clearly we're well above that now. The last I checked, the Atlanta GDP now forecast from the Fed was 3%. So, we've quite a ways to go. And that's where we get into the dynamic of how quickly the Fed is going to actually cut rates if growth stays that strong. So I think that's going to be the dilemma. That's where perhaps you have some mispricing in the market. Too much optimism on the rate front, but from an equity point of view, that's not per se such a big problem.
At a certain point, though, Dan, you have to wonder about whether the earnings ratify this sort of no landing scenario. And a number of different strategists pointed out that we have seen downward revisions to some of the forward-looking projections, particularly for some of the cyclical companies. How much does that raise concerns about you as we parse through the earnings of the likes of auto companies later this week?
Well, Lisa, I think the key thing to keep in mind, revisions clearly are important. Positive revisions are better than negative revisions, but we want to look at the absolute earnings growth that we think we're going to get. So even if you have negative revisions, but earnings are up a year from now, really the market should be up as well. So you want to keep it in perspective. Kind of inevitably, analysts tend to be too optimistic, so they revise down those estimates. But if there's growth behind it, that's going to be what matters.
Dan, how much are you trying to understand what the Trump trade is, what the Harris trade is, and how to really game that out at a time where maybe earnings matter, maybe the Fed matters, but right now all the oxygen's been sucked out of the room for the next 2 weeks?
Well, to some degree, I'd, at least over the next 2 weeks, argue perhaps the opposite. I think the election outcome is so uncertain. I think it's challenging for a lot of investors to think about how they would try to play an outcome, particularly when what honestly I think is going to matter at least as much, if not arguably more, is what happens in Congress, because that determines what the victor will be able to do. If it's divided Congress, clearly you have much more limited scope. If there's a sweep either way, and really anticipating that now, I think it would take a quite brave person.
Daniel, given that, the fact that we need to know the composition of Congress, and also the fact that if you look at these swing state polling, they're on a knife's edge. It's 50-50. It's a coin flip when it comes to this election in 2 weeks' time. Why do we see the markets rotating, though, towards a Trump trade?
Well, I guess as you pointed out, it all depends how you interpret it. I guess our focus is more on the medium-term outlook for the economy, and really under kind of any scenario you think you have for the results of the elections, it is still a quite positive outlook. Now, there's going to be difference on maybe what sectors do well or worse, depending on the configuration. But at a high level, we're optimistic, if you will, and have our overweight in equities in the U.S.
So basically what you're saying is regardless of the U.S. election, compared to the rest of the world, especially when you look at what's going on in China and the data there and Europe, the U.S. remains in this exceptionalism realm.
Really, it is hard to find another major economy right now that can match the performance of the U.S. We'll see how long that lasts, but for now at least, it does seem to be on a pretty positive trend.
Hey, Dan, it's good to hear from you. As always, Dan Morris there in London of BNP Paribas on the so-called Trump trade. Aditya Bhave of Bank of America writing the following: with the latest string of upside data surprises, client concerns have shifted from recession to reacceleration. In our view, the economy is resilient, but there are enough minor headwinds to make reacceleration unlikely. Aditya joins us now for more. Aditya, good to see you.
Thanks for having me.
So you don't believe in this reacceleration story. So let's start there. What underpins that view?
Not yet. So we don't believe in reacceleration yet. Let's talk about the recent data flow. Start with jobs. Obviously, fantastic jobs report for September, right? But we would think of that more like a mediocre student who aced one test. So good job, but we're not there yet in terms of, have you turned the corner, or is this really an A-plus labor market? I don't think it is just yet, right? And then if you think about the GDP, GDI revisions, the revisions were actually more to the older data, right, from early 2023, late 2022. So it's telling us a story more of a very resilient economy that's been holding on to around 3% growth in private domestic demand for 6 quarters. So it's not so much that we're reaccelerating, it's just that we've been growing well above what we thought trend was for an extended period of time.
What would change your mind? What would convince you?
So a couple of things could do it, right? The first one would be significant fiscal stimulus, but potentially after the election, but that would have to be over and above just extending the tax cuts, right? Because the tax cuts are status quo from the perspective of consumers and businesses right now. And then the other possibility is that you get a large negative supply shock. The economy is already running at potential. So with that negative supply shock, you could potentially overheat.
What is that negative supply shock? Is that sort of code for something?
Well, it could be a number of things, right? It could be geopolitics. It could be some significant disruption in terms of tariffs. Those are a few potential examples.
So you talk about the R word. It used to be recession.
Yep.
Now it's reacceleration.
Yes.
And I love this because it sort of puts into cold relief the idea that maybe this market sees the tail risk as increasingly reacceleration and not recession. Is that what you're seeing in some of the baseline data and some of the baseline analysis that you see coming out of Wall Street?
So the way we would talk about it is that 2-3 weeks ago, before we got the jobs report and the data revisions, we would have thought the risks to our outlook were slightly skewed to the downside, so more towards recession than reacceleration. Now we think the risks are pretty balanced. But the base case for us is still an economy that just softens up a little bit, doesn't go into recession, not even close, as inflation continues to move back down towards target.
Putting this all together, what are you expecting on November 7th from the Fed?
We're expecting a 25 basis point rate cut. We are comfortable with that view. Basically, the last jobs report did the work of two jobs reports, right, in terms of really delivering job growth. Then you had the upside revisions as well. You really had everything you wanted. So I think they'll be comfortable doing another 25, but they don't really have to do a 50 anymore.
But what if we get a really good jobs report before that Fed meeting? Is there a chance they don't cut?
The bar would be very, very high for that for a few reasons, right? If you don't cut in November, you're basically admitting that you made a mistake in September by going 50. And you've already told us that, look, we can keep cutting for now with policy rates growth close to 5% as long as inflation continues to move back towards target. The last inflation print wasn't great, but it wasn't terrible either. So they should be comfortable still cutting for now.
So given the fact that essentially you're saying it's not that the economy is reaccelerating, but we're staying around a level that seems like it's above trend growth, how much are you saying that maybe we need to reassess how far the Fed can cut? You know, the sort of the target rate has to be substantially higher than we thought maybe 2 months ago.
So this is exactly the question that I think everyone's wrestling with, right? So that there could be a few reasons why the target rate has gone up. The first one would be that inflation's just not behaving the way we want it to behave, right? But that would be more of an overheating story. The other potential story is that trend growth has gone up. Right? That could be because of labor supply, but it could also be because of productivity. So the other thing that's happening on November 7th, by the way, which is a little bit wonkish, is that at 8:30 we get the revised productivity data, which will include the GDP revisions, right? Nobody's paying attention to that because of the Fed and the election.
Correct.
But I think it'll actually be quite interesting because the story around productivity could change quite a lot, and that has significant implications for long-term growth as well as the terminal rate.
How much do you push back against people who say you can already see the trickle effects of the 50 basis point rate cut through the economy? You can already see mortgage rates coming down and bringing more people in. You could already see loan activity picking up on the margins. Do you reject that, or do you actually say, yes, in a way, on the margins, it has been stimulative?
To the extent that that's happening, it's got to be very, very marginal, right? I mean, they cut rates in the middle of September. We have some of the September data, right? We don't have any of the October data right now, so we really wouldn't see it in any meaningful way in the data right now.
Aditya, always good to catch up with you, sir. Aditya Bhave there of Bank of America. This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.